This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 8 deals with sources of information. And the first slide shows sources of information typically available in a conventional trading or manufacturing company. The important things about this internal information is it can be made easily available for very little additional cost. We're not going to look at all of these in any sort of detail, but if you just look at information available from a sales system, there is a treasury of information. We can work out which customers are going to be more profitable, or certainly which customers are most important to us. We can work out how the sales are going to vary over time and so on. We can work out how sales of different products are popular, perhaps going to particular customers and so on. We can work out the profitability of the different product lines, different customers, and indeed different countries. All available really for, as I say, very little additional effort, especially as most sales and sales transactions are going to be recorded nowadays on computers. If we go down to, say, the third one, payroll system, number of employees, what they're paid, how many hours they work, absenteeism, we could link it to productivity records and so on. We can keep information about their qualifications so that if we need an employee who is an engineer and who speaks German, we can easily find one. Down here in production, we can keep track of machine breakdowns, productivity. We can keep track perhaps of quality. We can bring that in there as well. We can keep and monitor different machines to look at their reliability. We can keep records of how the maintenance of each machine has been kept up to date and what they're going to be needing next time. Fascinating information available really for free. Now, we can extend this a little bit away from conventional trading and manufacturing organizations into not-for-profit organizations. They tend to have less standard sources of information or types of information, but just a little bit of imagination can easily generate for you some ideas. So if we think of a hospital, what sort of internal information would be useful in the hospital? And obviously we can get costs of staff. We can keep track of costs of drugs and medicine. We can work out the costs of different procedures, different sorts of operations. We could keep track of the number of days on average patients are in for a particular procedure. We can look at success rates, mortality rates. We can look at utilization of scanners and operating theatres. All really useful information for performance management. In a school, we can look at pass rates, we can look at absenteeism, we can look at class sizes, we can look at perhaps the cost per class, the cost per subject even, the cost of books, and so on. All available internally for very little information, provided management sets up systems which are willing or able to report this. When we come to look at external information, there is almost an endless source of external information available to people. Many, of course, of the pieces of information now available really through the internet. The trouble with the internet, as we'll mention later on, is of course you never quite know the quality of information which you're going to be getting from that. So the internet here just needs a little bit of care, perhaps. However, we can go to websites of suppliers. We can find out the price of what they're supplying. We can look at alternative suppliers. We can go to the websites of competitors, see what the specifications and prices of the products are. Again, very often, very quick, very easy, and the like. We can go to, again, the website and so on. We can perhaps go to statistics which are available for particular countries. If we're thinking of going into a country, exporting to a country, setting up branches in a country, we need some sort of forward information about how the economy of that country is forecast to go, the size of population in the country, perhaps the competitive nature of the environment which is in that company. So huge amounts of information from all these sorts of sources. Sometimes you have to pay for it. Sometimes down here, business inquiry agents, what you're really doing is going to a marketing consulting agency or a consultancy which collects information, economic information, for example, or information to do with a particular business sector, and you can pay them to give you information about competitors, how the market is faring, what the forecasts are going to be. If we're getting information from computers, and nowadays 90% of information is going to be coming from computers, we need to make sure that the information is, certainly the internal information, as far as possible that it is accurate. And the first step is to make sure input is okay, because if you input rubbish into the computer, it can just be processed through and will produce rubbish at the other end. So here are some of the methods which can be used to try to ensure that information being put in is okay, and this will maximize the chances that information coming out is reliable. So passwords, obvious, giving access, not letting unauthorized people putting rubbish in and so on. Also, the password can be linked to the information, so that later on you can see who was responsible for typing that sort of information in. Range tests. If somebody normally works 40 hours a week, a range test can prevent 60 hours a week being put in on a timesheet until special authorization is provided. This will stop typos. Format checks. We've come across this in credit cards on the internet. Credit cards, there's 4 groups of 4 digits. The credit card number is 16 digit. This will reject something where maybe you only put in 12 of the digits, or you put in 17 or something like that. Dependency checks, where one piece of data implies something about another piece of data. So we've all probably been caught out arranging travel on the internet, where by accident your return journey happens before your outgoing journey. And it'll come back very quickly and say, this can't be right. The return journey must be after the initial journey. There's nothing wrong with either of the dates independently, but return can't be dated before going out. Check digits, specially constructed data, numbers, account numbers, part numbers, employee numbers. They have to comply to certain mathematical rules. And if you mistype something, the chances are these rules will not be complied with, and the machine knows it's wrong. Sequence check. Sequence check, accountable documents, pre-numbered documents. If you expect all documents to be put in and they have sequentially pre-numbered elements to them, a sequence check will be able to report missing documents and will be able to prevent the same document going in twice. Matching. For example, all employees are supposed to put in a timesheet. And if one employee hasn't put in a timesheet, it'll report that there's something missing. And finally, control and batch totals. If you're putting in, let's say, 50 invoices, you add them all up. There's a control total that's put in first. And then when you enter all of the documents coming after that, it adds them up and makes sure it reconciles to the control total. It's also important to safeguard data once it's in the machine. And of course, passwords are going to be very, very important in that, again, to control access to the machine. But also think about backups, think about virus software, think about anti-hacking software. You only have to think about the desperate damage that was done to Sony towards the end of 2014 when their system was hacked into. And we heard about films being leaked, unreleased films being leaked. We saw emails which were embarrassing to management of Sony. But what it meant was that people on the selling side of Sony didn't know what they had sold to their customers previously, didn't know what prices they'd charged to their customers. So going along to customers, trying to sell them something, not knowing whether they perhaps had bought that before or not. And it almost paralyzed for several weeks the operations, the commercial operations of Sony. So really, really important, if you're relying on this data, that you're properly safeguarded. Otherwise, once you lose that data, you're in really big trouble. Qualities of good information. We've got two lists here. The first one going down here is the accurate mnemonic here. You've come across that before, probably. You're not going to be asked outright what are the qualities of good information. The way this tends to be examined is that you're given a report and you're asked to perhaps criticize it or suggest improvements. So information has to be sufficiently accurate. That doesn't mean it has to be the last cent for everybody. It could be rounded to the nearest million in some very large companies, but accurate enough for its purpose. It has to be complete. Missing information is misleading. Cost beneficial, even in not-for-profit organization. Providing information, a lot of information can have a cost, and we must make sure that there is a benefit being derived from that, either increasing profits or increasing perhaps the number of patients you can see, the number of students you can deal with, whatever the mission says is essentially the benefit you're looking for coming from this organization. It has to be understandable, user-targeted. I want information which is going to be useful to me. I don't want irrelevant information. We're going to have to plow through that only to decide that it's not for me, it's useless to me. We want it to be authoritative and adaptable. So it'd be nice to be able to present information in different ways. And then secondly, authoritative. And this is where I go back to what I said about the internet. Be wary. Be wary when information is obtained from the internet. You type a search term into a search engine, you don't know quite what the quality or reliability of the information you're getting out is going to be. You want it quick enough to be able to help you with your decision making. Sometimes information has to come within a few seconds. Sometimes it could be a couple of weeks before you really need it. Faster information, more accurate information tends to put the cost up, and we have to get a balance really to get this cost beneficial quality correct. And easy to use. Has it been presented with nice columns, nice subtotals, perhaps some of the subtotals in bold and so on, proper explanations against each row showing what the information is actually trying to tell us. The second mnemonic we have here, this one which is talking about pale, was developed specifically to deal with those sort of questions where you're asked to criticize a report. And quite a lot of them gave as part of the question the kind of objectives or the aims or the mission of the organization. And then it had a report. And what was happening is that several things in the mission were not mentioned in the report. And of course, if you are trying to report on how well the organization is doing, how well an organization is doing really depends on what it's supposed to be doing, and that goes all the way back to the mission. So you need to think of what is the purpose of the organization, and are we reporting on all the facets of its purpose? Think of the audience. Some audiences are going to be very technical and want lots of technical information. Some audiences only need a summary of the information, are perhaps not technically minded, and will never read through a 20-page report of huge detail. They just want a bit of a summary. What information should be there? It should be relevant information. It should be comprehensive enough to allow people to draw the conclusions they're supposed to. And finally, what's the layout? Sometimes using graphs might be more effective. If you have a table of figures, it can be quite difficult to discern trends within that, but a graph showing sales going up and the costs going up slightly more slowly is kind of immediately saying there's quite good news there, because the profit profit margin, if you like, is increasing. And we want, again, nice headings, nice subtotals, not too much information and so on. That's going to be confusing people. So this is really quite a good little mnemonic. Control loops. Control loop, let's look at control loops. This is very often what's done by the information, what's done with the information, where we get it. Let's think about a control loop in a manufacturing organization, where typically what they will have done is they will have set standards. So it'll be, let's say, material cost per unit, usage per unit coming out, cost per kilogram, usage per unit. And then what they do in manufacturing is they begin to issue some material. It goes through the production process and it produces some products. And what we do over here is we measure how many products we've got, what the cost of the material per kilogram is, and what number of kilograms we've used for those products. And what we do is we compare that to the standard. So that's what we should have done, really. It gives an indication of what we should have done. This is in a way what we really did do. And the comparator, essentially it's creating variances, is a comparison of the actual and the plan, the actual and the budget. And what we do is we look at that and we decide whether or not we need to adjust or effect a change. So if there is a large adverse variance on materials, you would go back to the people in production and you say, look, you need to become more efficient. You need to waste less material. You need to buy it at a lower cost, whatever you think the solution is going to be. And round you go again. If it was a comparison showing things are doing better than expected, you should still do an adjustment. You should go to people and say, last month you were really efficient. You came in under the cost per unit, which we had budgeted for. We want you to do the same the next month. What we've been talking about there in these cost budgets is really feedback. Something has happened in a month. After it's happened, we analyze how well it's happened, and we say this went wrong or this went well. This is what you need to do next month. So it's looking back at what happened. You're not correcting what happened, but you're stopping it or correcting, or you're making adjustments to the future. Feed forward control is really where you spot something that's going to go wrong in the future and you prevent it happening. For example, you have a you have a cash flow forecast set out on a spreadsheet. January, February and March sales are a little bit disappointing. And this is showing you that the cash flow, therefore, by the time you get to September, you're going to go over your overdraft limit. We're not in trouble yet, but we're going to be in trouble in September. So what you say to people is perhaps, right, no more capital expenditure. Maybe what you say is, let's go and try and negotiate a higher overdraft limit. You are feeding forward to the difficult time in the future, and you're trying to anticipate or prevent something going wrong. Feedback can be positive and negative. If costs are above budget, that will be negative feedback. You're trying to bring them back down, push them back down to what the budget was. If sales are above budget, that would be looking at positive feedback. You want to keep it even further above budget. You're pushing them away from what the standard or the expected performance was. And finally, there's delays. Delays can be introduced at each of these stages here. So you could envisage a situation where it maybe took a month for the management accounts to be produced. And then maybe, because of the timing of that production, it was another month before the board of directors met to discuss those management accounts. And by the time they issued directives and so on to people in production, in a really bad case, it might be another month before anyone thought about doing anything about it. And that's kind of pointless, really. If you are having this feedback or indeed feed forward situation going on, you really want the correcting activity to be applied as quickly as possible. And this is something which computing has helped. It used to take quite often and indeed quite often monthly management accounts were produced once a month, and sometimes it would take two weeks to produce those. Now, if you go to a retailing organisation, every morning they will know what yesterday's sales were for every product, for every shop. You get this instant information available, and before the day is out, they will be saying, right, this product is selling badly, let's cut its cost. Or this product is selling really well, let's make sure we order more goods to keep up with that demand and so on, because this is the way we're going to be making better profits. So cutting down on necessary delays is important. Getting the information in a timely fashion so that you can actually put through the adjustment quickly enough is something which is greatly helped by the introduction of computing. Finally, in this section, we'll look at integrated reporting. This is a relatively new part of the syllabus, hasn't been examined yet. What we're trying to do is get away from just financial reporting, a set of financial reports, balance sheet, profit and loss account, cash flow and so on. And we're trying to get a much more integrated report showing strategy, governance and performance. The idea is that this will, if we have all of this information around, and particularly the big difference is looking forward, perhaps at what the strategy is going to be, what the outlook is going to be, it should enable better decisions to be made by the board. It will improve the information available for investors. Investors are obviously interested in what happened in the past, but they should be rather more interested perhaps in what's going to happen in the future and what the prospects of the organization is going to be. And it should encourage more integrated thinking in business practices. So if the economy is forecast to go down, but the board is thinking let's build more factories and so on, there's a kind of a bit of a mismatch there. It's really not going so well. I'm not going to say very much about the guiding principles, not huge amount to say there. If we just go to some of the last four here, we want to talk about things which are material. It's going back to what is good information. You don't want it cluttered with stuff which is of little relevance to people. So material, it should be fairly concise. It should be complete and reliable, and it should be consistent. So from one year to the next, if we're looking at forecast sales, forecast investment, forecast number of employees even, we want to make sure that the comparisons that are being put in front of us are consistent, so it actually means something. I think for the purposes of the exam, as well as knowing the purpose of integrated reporting, knowing the contents is important. And in many ways, the contents is like a mini strategic plan. Organizational overview and the external environment, what our trading and competitive environment is like, and indeed the economic environment. How are we governed? What's the governance? Is it, balance of executive and non-executive directors? Do we have an audit committee, a remuneration committee, a nomination committee, and so on? Is quite important because the idea is that good corporate governance will improve performance. That's why it was brought in. The single person who was chief executive officer and chairman, who had almost unlimited power, was not the way to get good performance. It was gambling with that person's decision making. The business model, for example, cost leadership, differentiation, or are we going to expand by acquisition? Are we going to expand perhaps by using franchises? Risks and opportunities, in many ways a SWOT analysis which is going on within there. Again, giving investors and members of the board an idea of what they need to watch out for in terms of risks and where they need to be trying to perhaps make decisions which capitalize on opportunities. Our resource allocation, why we've decided to put up some new factories and use the money for that, rather than perhaps expand abroad. Performance, explain how that went last year. The outlook, what we're expecting to do next year. And of course, outlook is something which many directors might be a little bit reluctant to say very much about, because when it comes to next year and the outlook, forecasts from last year turn out to be rather optimistic. They're going to have some explaining to do about that year's performance. And finally, the basis of preparation, how we have perhaps got to our budgets, how we've made certain assumptions and the like, where we've got the information from, can also be of importance. We're now going to look at non-traditional methods of judging performance. Of course, the traditional method, which you're all familiar with, is to use the financial mechanisms. We have ratio analysis. We look at earnings per share, the way it may be increasing, gross profit percentages, gross profit, current ratios, all of these financial measures that you've been learning almost from when you began your accountancy training. Now, these are all essentially profit-based, certainly financial-based. The trouble is that they're rather narrow and rather short-term. Most financial results are only for a period of a year. Certainly those which are published are only for a period of a year. And many budgets are only looking forward to a period of a year. And that's not very long in the scheme of things. And they're also very narrow. Is profit, particularly short-term profit, only measured for a year, is profit really the only thing that needs to be measured? Because nowadays people are looking much more at problems to do with sustainability. Sustainability of their business in the long term to continue making profits, which are adequate to repay the investors for the risks that they're taking with their money. And also profits and operations which are sustainable in the long term, because perhaps of their impact they have on the environment, and through changing tastes and maybe through the impact of different laws being passed. So the idea of a single measure of performance is being extended somewhat in many cases. The first extension we can call the triple bottom line, and it talks about profit. It also then talks about planet, and it also talks about people. So basically, when you're looking at planet, you are looking here at the environmental effect of the business. Is it depleting resources quickly so that in 5-10 years' time it won't be able to operate anymore? Is it creating a lot of pollution so that laws and so on may be brought in? Or, of course, pollution of itself isn't a great thing anyway, and is increasingly looked at by consumers, for example, to see what the carbon footprint might be in some of the goods being produced. And then social or people here. What is the effect of the business on the people associated with it, the employees, for example, the people living in the neighborhood of the business who may be inconvenienced through noise or pollution or heavy traffic and the like. And of course, employees come in here. Employees have evolving wishes, for example, the balance of money versus free time, the way they want to be treated in the business, perhaps expecting a more discursive way of doing business, a more participative way of doing business, rather than being told what to do. So some people say that the business should be reporting really in these three fronts: the profit, the environment, the planet, the effect on these, and the social or the effect on the people. This would obviously broaden what's being reported on, therefore has to broaden what is being measured, and many of these will look more towards a longer term. People, what sort of training are we going to give people? What if, population is diminishing and we have to hang on to the best people to stop them transferring their skills and so on to another employee? Now, very laudable though it is, there are certain particular problems about it. First of all, how do you balance or compare the results of the three parts? To put it very, very crudely, we could very often increase our profits if we were to take less care about the environment. If we weren't as careful about cleaning up gas emissions, water being drained into the local river and so on, we could probably make better profits, certainly in the short term. But how do we actually go about balancing these, convincing people that perhaps spending more now, reducing profits now, is first of all a good thing, but secondly, is going to help the longer term sustainable profit of the business. Second problem that we need is how we're going to measure these. How do you measure a business's effect on the environment? The noise. You can measure the noise, but you don't know the impact it has on the environment. You can measure how much is taken into the business by way, say, of metal ore, but how much is left? How are we going to run out of it? How much other damage is done by the mining effort and the energy expended in transporting the iron ore or whatever it is to the factory? Should we take into account, if we buy in goods, should we take into account their carbon footprint and the impact that those goods have had on the environment and so on? We probably should, but I think what I'm saying here is there can be a real difficulty in measuring and assessing some of these. They're certainly not prone to, if you like, the way we measure many things in profit, where you have accounting standards which say this is the way you're going to measure certain contentious items. There is no standard way of measuring many businesses' effect on the environment. And third, this is very much voluntary. There is no legal requirement as yet to report in this format, nor any standardization between companies which would allow these measures to be compared. So they were difficult to standardize, to measure. Different companies would come up with different definitions of what they meant by pollution, or what they meant by happy workforce, fair practice in the workforce and so on. But if every company is doing it slightly differently, it's going to be really quite difficult to decide which one is the best. Another approach which is talked about is to say that maybe the whole idea of traditional budgeting is a bit old-fashioned and could be actually detrimental to a business. You know the way a business budgets, maybe up to a year ahead of when the budget period is going to be. It begins thinking of forecasting, begins thinking of planning, it begins thinking of how much cash can we spend there, and there. It begins to think of resource splitting the way it's going to be using its precious resources. And this is well ahead of the time for which the budget is actually going to apply. And you could easily get the budget allocation of the resource allocation wrong because your forecasts are wrong. And furthermore, once you have said, right, this is what we're going to do, this is how much cash, for example, this subsidiary is going to get or this department is going to get, then no matter what happens, the budget has this effect of almost being chiseled into concrete, so that it becomes very, very difficult in many organizations to depart from that budget and to be flexible and to respond to what's actually happening. Many, many people are involved in a budget. Many, many people have set their sights on achieving the budget, and if the budget changes, then in a way you're going to repeat this whole difficult process of agreeing the budget and getting to one again and ensuring that people are motivated by it. So beyond budgeting takes the view that conventional budget problems consist of them being very time-consuming and costly to put together. Not only that, but once they're put together, and then after the period, and you're looking at variances between budget and actual, an awful lot of management time is spent thinking up how they could explain a difference between the budget and the actual. How can they explain an adverse variance? As it says, it constrains responsiveness, flexibility and change. It's in the budget, so it almost takes on a life of itself, which is very difficult to change. Rarely strategically focused, most budgets are for the next year. That's a really important one. Some people try to do a 4 or 5 year plan, but really people are saying, after a year it's very difficult to predict. And what we might have is a kind of pressure to show that next year's profit is good, has increased in last year's, but it's not going to be sustainable once you get into the future. Very often they concentrate on cost reduction, not on value creation, not on new ways of creating revenue streams. Budgets tend to be very much top-down. It is people handing budgets down the organisation. You get this vertical control, and so on. And whether or not this actually reflects emerging network structures is kind of hard to know. Will this vertical command really lie easily with more participative, more discursive ways of imagining a budget? It can encourage gaming and perverse behaviour. So you could imagine a salesperson knowing that a big sale is going to come in December, but knowing that the budget has already been beaten this year, would take steps to defer that sales to next year so that it takes a bit of pressure off achieving next year's budget. They tend often only be developed every year, and in a fast-moving environment that is almost certainly too infrequent. They're based on unsupported assumptions and guesses. Even looking a year ahead is very difficult. People are just saying, well, I think we might sell this. We think the competitors might do that. We think inflation on energy costs are going to be doing this. And it doesn't take very long before these assumptions and so on are proved wrong. There's an old saying that one of the great generals said, every battle plan survives until first contact with the enemy. And it's like every budget survives until first contact with January. It reinforces departmental barriers. Budgets are usually broken up between departments, sales, production, purchases and so on. If sales thinks it's going to be beating the budget, then it has to get in contact with production. Production may be reluctant to change because that's going to increase its work, it's going to upset its plans and so on. And very often they can be used to isolate these different departments, make them look after their own performance more than they're willing to look after the performance of the whole business. Beyond budgeting instead says that we shouldn't be measuring success against the budget, we should be measuring against the competition. Sustainable profits means that we're going to be reliably beating the competition in the long term, and that's what's important. Target setting shouldn't be set on what we did last year, it should be set on external benchmarks. If a competitor, say, has only one unit in 1 million, which is failing and has to be returned, then that's what we should be doing. We shouldn't be happy with our 1 in 100,000 failure rate. Rather than giving people fixed budgets, which can be extremely demotivating and much more difficult for you to make, if you like, imaginative decisions, beyond budgeting would do far more delegation, far more empowerment of managers and staff to make their own decisions. It will allow them to act more independently. It will give them freer access to resources. If a manager thinks that they need a new machine in the business, then they're able to go and request that, rather than simply saying, well, it's not in the budget this year, we have to defer it to next year. Now, beyond budgeting doesn't suggest a free-for-all. It doesn't say that managers all over the place can go and kind of spend almost random amounts on new machinery. There has to be still a certain control element there, but we're trying to get away from, say, a rigid revenue budget or a rigid capital expenditure budget to allow much more flexibility and change during the period so that businesses can react quickly and in inventive ways to new challenges. And the organisation should be based on customer-orientated teams. It is the customers here who are responsible for giving you money. And they give you money because you produce goods that they wish to buy or services which they want to make use of. And you should be looking at competition, you should be looking at what customers want, and the budget should be much less important than it maybe is in traditional setups.